when you look at the purchasing managers indices rolling over, that's generally not a very constructive environment for the equity indices. Then you can look at things like the copper to gold ratio. Basically, a lot of confirming indicators suggest that we're maybe not in a strong phase for U.S. equity indices. The 2000s decade was a weak decade for the dollar. You came off the big high that went into the dot-com bubble, and what did well? Value equities, right? So banks, real estate, energy, those markets did very well during the 2000s decade with a weaker dollar. Then if you go back to the 70s, what did well? And we had the dollar came off the Bretton Woods system. That was a weak decade for the dollar, and basically energy did very well, and the Nifty 50 stocks, all those growth companies, are the ones that struggled the most. And so, the dollar, we've had this inverse correlation where, the markets go up when the dollar goes down and vice versa. But if you have like a more structural rotation where, a lot of capital just stops piling into, say, the big growth mega caps and starts being more picky towards some of the more value-oriented sectors. I think, yeah, basically you could have a weaker dollar, you could have a weaker broad indice, but you still have attractive sectors that are doing well. And I think that could also buoy some of the international equities that are tend to be more, their indices tend to be more value weighted. When I look at other sectors, I think defensive value is interesting. And so I think the healthcare sector, especially, when people think of healthcare these days, they often think of the vaccine plays. That's been a very big theme over the past couple of years. But I'm talking about just other areas of healthcare. So pharmaceuticals, insurance, health insurance. I think some of those are rather appropriately priced. Some of them pay decent dividends and they have decent growth forecasts. And so overall, I think that's an area that is still, has basically good risk reward fundamentals in it. So in the United States, we've had a large series of tax cuts, and a lot of people look at headline tax rate, which actually doesn't change that often. I mean, it changed under the Trump administration, but prior to that, it didn't change for a while. But if you look at effective tax rates, those are the tax rates that really matter. That's what you pay at the end of the day. And so if the headline tax does not change, but various deductions, or you can call them loopholes, if those things change, you can pay more or less taxes. And so if you chart U.S. corporate tax rates over the past several decades, it's been this pretty persistent downtrend in corporate tax rates. And if you look at, for example, where tax revenue comes from as a percentage of total tax revenue, it's really shifted from corporate tax rates to payroll tax rates. And this had a couple implications. One, obviously, we shifted, less, partially from companies onto workers. But then also we have to keep in mind that employers, those companies also pay payroll taxes. But yeah, the ones that pay more of them are the labor intensive ones, right? So the big beneficiaries are the very labor light companies, software, financials, some types of healthcare companies. These companies generally they earn a lot of money without having a lot of American workers, and so they benefit from cutting corporate tax rates on profit, even if their payroll taxes are still kind of going up. Most oil producers will only sell their oil in dollars, no matter what country's buying them, right? So if France or Japan wants to buy oil from Saudi Arabia, they're paying in dollars. And by extension, the implication of that is that every country that needs to import energy needs dollars. And so they can either exchange their currency for dollars, or they can start selling their own exports for dollars. And then on top of that, we layered the Eurodollar system, all the debt markets. And so the dollar became the major funding currency. So entities around the world borrow in dollars, not really often from the United States. They're often borrowing dollars from Europe. They're borrowing dollars from China. And so just because they owe dollars doesn't mean they owe them to the United States. The United States is a net debtor. Many of these other countries are net creditors. But the point is it's denominated in dollars. And so the combination of needing to buy energy in dollars, most commodities in dollars, and having debts repayable in dollars has made the dollar the reserve currency. So overall, if that trend were to happen, that should be weaker for the dollar. That should be more reflationary. That should be positive for several types of emerging markets, especially ones that tend to be a little bit more commodity oriented. And so that's, I think, a general trend to look out for over the 2020s decade. I don't think it'll be a straight line. Generally, when we see periods where the dollar becomes overbought on the weekly chart and then rolls over into negative momentum, it's not a perfect signal, but I think it's one to watch because generally when that happens, more often than not, that has tended to resulted in a pretty significant and longer duration kind of more often than not it's a decline in the dollar relative to other currencies. Sometimes the dollar still stays heavy. I mean, it still stays strong, but maybe it stops going up at the same speed that it has been before, so it can kind of slow down. And so I think that's something to watch going forward. One thing I would point out is that gold has a pretty strong inverse correlation with real rates. And we've had this pretty strong jump recently in real rates, and gold really shrugged it off. There was a period of time over the past 12 to 18 months where, things that should be good news for the gold market didn't really move it. And now we're starting to see things that should be kind of bad news for the gold market not really move it. And that tends to be a pretty bullish sign. And so I think aspects of the market are starting to maybe sniff out that I think the dollar could run into a little bit more headwinds going forward. But it's we have to watch the price signals because we can do all the fundamental analysis, we can put the pieces together, but we have to start seeing if price confirms it because that starts to point to are there variables that we're missing? Is it starting to go the way we expect, or do we have to go back and reassess? So I'm not like calling a super high conviction statement that the dollar's going down now, but I've observed a couple patterns here. I think that a lot of the dollars have been bid because people are piling into the U.S. growth markets, and so I think that if that starts to unwind, or at least if it stops accelerating the way it has been, I think that could start putting pressure on the dollar. So instead of speaking kind of price terms, I think in overall just what do I expect overall? And in general, I'm not necessarily calling for a crash. We could have one, I don't know. But it just generally when you add a couple of these things together, so when the Fed balance sheet stops increasing, ever since the global financial crisis, that's been pretty challenging for indices to keep going up. The big exception was during 2017 when you had, massive corporate tax cuts, right? So we either need generally monetary stimulus or fiscal stimulus to keep the equity markets in the U.S. going up at least at the rate that they do during those big bull stretches. And so that seems to be kind of in the rear view mirror now, and now we're getting to a tighter period for central bank balance sheets as well as for fiscal stimulus. So that's a variable to watch. Two, when you look at the purchasing managers indices rolling over, that's generally not a very constructive environment for the equity indices. Then you can look at things like the copper to gold ratio. Basically, a lot of confirming indicators suggest that we're maybe not in a strong phase for U.S. equity indices. Now, the funny thing is, I mean, you could still actually have a positive year or a positive 2 years. But I would say that even if that happens, you'd probably, I don't think we're going to get the growth that we had over the past 2 years, right? So I don't think it's going to be a straight line up. You could eke out a positive year, but I think it would be a weaker year.